If you have been winning for 2 years, pay attention, not because you have done something wrong, but because winning is exactly the signal the market uses to convince you that you know what you are doing. And sometimes that is the only signal it needs to destroy you. Winning does not prove skill. Sometimes it only proves that randomness has not collected yet. Entire strategies, entire funds, and entire careers worked for years until the exact day they stopped working. And the operator inside did not fail at the end. He failed much earlier when he interpreted a favorable streak as evidence that he was good. This video is not against trading, or against taking risk, or against making money. It is against a more dangerous lie, believing that every good result confirms a good decision. That lie is comfortable because it lets you sleep peacefully. If you won, then the process was good. If you lost, then the market was unfair. But markets do not work like that. In real markets, a bad decision can pay you several times before destroying you, and a good decision can lose money even when it was correctly structured. That is why the result matters, but it is not the final judge. It is evidence. Nothing more. In the next few minutes, you will learn 3 concrete tests. The first tells you whether your profit survives alternative histories or whether it only survives in the single history that actually happened. The second teaches you to judge decisions by the process, not by the economic result. The third forces you to protect your right to keep playing, because no average return matters if one single event takes you out of the game. This is not pretty theory. It is the difference between someone who lasts 20 years and someone who lasts 3. The structural problem of any market is that luck and skill can produce the same curve for long enough to confuse you. While you are inside a favorable regime, you do not always know whether your return comes from a real edge or from the environment. If volatility is low, if liquidity is abundant, if interest rates help, if correlations behave, many strategies look intelligent. But when you have been winning long enough, your brain builds a narrative. You begin to believe your process is superior. You increase size. You concentrate. You leverage. And when the regime changes, you discover that you were not trading with an edge. You were exposed to a condition that had not yet broken. Skill exists. Real edge exists. But real edge is measured against large samples, alternative scenarios, and survival under stress. If it is only measured against 1 year's result, it is not edge. It is a lucky hypothesis. So the question is not only how much you made. The question is what exposure produced that gain and whether that exposure remains alive when the environment changes. That is the thesis of this video. The market can reward you for a bad decision long enough to convince you that you are good. And once you have built identity, confidence, and size around that decision, randomness collects the bill. Taleb is not useful here as an author to quote in a review. He is useful as an operational alarm. He forces you to separate 3 things the ego joins too quickly: result, skill, and survival. Result is what happened. Skill is the quality of the process that could have produced it. Survival is the condition that allows you to keep learning after being wrong. If you only have result, you do not have a system. You have a pleasant story. If you have result and skill but no survival, you have a statistic nobody will read once you are no longer in the game. And if you have survival without reviewing the process, you may last, but you will learn slowly. The serious operator needs all 3: result to measure, process to decide, survival to remain. Let's go to the first playbook. Detecting false skill. Before looking at a chart, an account, or a company, you have to accept one uncomfortable truth. The market does not give you labels. It does not tell you this was skill, this was luck, this was cycle, this was excess liquidity. It only gives you a result. The operator's job is not to fall in love with that result before understanding where it came from. If you do not do that work, your own profit becomes dangerous, because a loss forces you to look. But a gain gives you permission to review nothing. And that is where fragility begins. That is the trap. First test. Does what you call skill survive if I change the history that happened? I am not referring to an extreme fantasy. I am referring to reasonable alternative scenarios. Another rate decision. Another day of dry liquidity. Another breakdown in correlations. Another spike in volatility. Another execution failure. A victory only counts as skill if it would have survived several alternative histories, not only the single one you happen to live through. The classic case is long-term capital management, known as LTCM. The fund had Nobel Prize winners, quantitative models, reputational capital, and outstanding returns. They were not amateurs. The technical skill was real. The problem is that a strategy can be technically brilliant, and at the same time be built on conditions it does not control. In LTCM's case, the strategy depended on relatively stable historical correlations, abundant liquidity, and heavy leverage. While the regime helped, the curve seemed to confirm sophistication. But when the Russian crisis of 1998 arrived, the conditions supporting the model changed together. Liquidity disappeared. Correlations stopped behaving as they had in the past. Leverage amplified everything. The fund lost an enormous portion of its capital in a short period of time, and a group of major firms had to recapitalize it to avoid a disorderly liquidation. The lesson is not that models are useless. That would be a poor reading. The lesson is that a model can describe one environment well and fail when that environment stops existing. That is different. And it is far more dangerous because for years the model can appear correct. It can produce money. It can attract capital. It can convince brilliant people. But if you have not asked what happens when the conditions your strategy depends on change, you do not have a complete strategy. You have a bet on the continuity of the regime. Apply this to yourself. Take your biggest gain of the last 12 months. Do not look at it as a trophy. Look at it as evidence under suspicion. Write down 5 plausible alternative scenarios. 1. Liquidity shock. 2. Volatility shock. 3. Interest rate jump. 4. Correlation breakdown. 5. Execution or infrastructure failure. Now ask yourself, in how many of those scenarios would my gain still make sense? If it only survives in 1 out of 5, it was not pure skill. It was fortunate positioning. And there is nothing wrong with being lucky. The problem is increasing size as if that luck were edge. That is where randomness begins to finance your overconfidence. The common mistake is assuming that a positive result over several months or several years validates the method. Not necessarily. Sometimes it only proves that your method has not yet encountered the scenario for which it was fragile. That is the difference between temporary survival and robust skill. Temporary survival says, it has not blown up yet. Robust skill says, I understand which conditions pay me, which conditions damage me, and which conditions take me out of the game. The audit question for this playbook is simple. If I change the market regime, does my gain still remain reasonable, or does it turn into ruin? If the answer is ruin, you are not forbidden from trading, but you have to treat that gain as exposure, not as identity. Because when you turn favorable exposure into identity, you stop seeing it. And what you do not see, you scale. That is when a good streak stops being good news and starts becoming flammable material. This test also works outside trading. A founder may believe their product won because it was superior, when in reality it won because of a cheap distribution window. A salesperson may believe their script is brilliant, when in reality the market was buying anything. An investor may believe they detected value, when in reality they bought beta during a bull cycle. In all those cases, the result looks the same from the outside. Growth, return, confidence. What changes is the hidden fragility behind it. So the question is not whether you won. The question is under what conditions you won. If you cannot name them, you do not know how to repeat them. And if you do not know how to repeat them, you cannot scale them responsibly. The amateur operator asks, how much did I make? The professional operator asks, what had to be true for this to work? That difference seems small, but it changes everything. Because the first scales emotion. The second scales verifiable conditions. Second test, was the decision good or was the result good? They are not the same thing. A good decision can lose money and a bad decision can make money. If you confuse those two things, you repeat the mistake and scale it. This is one of the most expensive errors an operator can make, looking at the result as if it were a perfect audit of the process. If it won, he repeats it. If it lost, he discards it. But the market does not grade like that. The market can pay a bad decision for reasons unrelated to your thesis. It can punish a good decision that has not yet had time to mature. And it can do both long enough to confuse you. The case of 14 and Volmageddon shows this with brutal clarity. For years, being short volatility seemed like a money printing machine. Volatility was low. The VIX index seemed asleep. Premiums came in consistently. Drawdown seemed manageable. For many, the trade seemed rational. Sell volatility, collect premium, repeat. On the surface, it was discipline. Structurally, it was something else. Small and frequent gains in exchange for a catastrophic loss if a violent spike in volatility appeared. That is the trap of many strategies that seem stable. They do not eliminate risk. They hide it in the tail. On February 5, 2018, the spike arrived. The XYV product suffered such a severe collapse that it was suspended and removed from the market. The problem did not appear that day. That day, it only became visible. The fragility had already been inside the structure during the good years. And here is the uncomfortable lesson. The process was the same when it was winning as when it collapsed. The difference between looking like a genius and being destroyed was the calendar. That is what outcome bias prevents you from seeing. When you evaluate by result, the market can train you backwards. It pays you for fragile behavior. You interpret the payment as validation. You increase size. You reduce doubt. You repeat with more confidence. And then, when the event your process did not protect against appears, you say it was a black swan. But many times it was not a black swan. It was a known tale, ignored because it had not collected yet. The practical action here is simple and tough. Keep an ex-ante journal. Before every relevant decision, write 5 things. First, the thesis. Second, what invalidates that thesis. Third, the size. Fourth, the maximum acceptable loss. Fifth, the concrete reason for entry. After the result, evaluate against that paper, not against the money that appeared in the account. If you won for reasons different from the ones you wrote down, you won by randomness. And that is not a sin. The problem is treating that randomness as a signal to increase size. If you lost but the process was correct, do not destroy the method over a single sample. Adjust, review, and keep measuring. The point is not to ignore results. The point is to put them in their place. The result tells you what happened. The process tells you whether it makes sense to repeat it. The audit question is this: if this same decision ended in a loss, would I still defend the process that produced it? If the answer is no, you probably never had a process. You had attachment to the result. And if you can only defend a decision when it wins, then you are not making decisions. You are looking for confirmation. This test has an uncomfortable consequence for any trader or investor. You have to congratulate your gains less and review your entry conditions more. A winning trade can be well-paid garbage. A losing trade can be a normal part of a robust system. The only way to distinguish them is to have written the logic before knowing the result. After the result, the brain cheats. It cuts out what does not fit, exaggerates what does, and turns accidents into stories. That is why paper matters. Not because it is magical, but because it fixes your thinking before the result contaminates it. You also need to separate sample from anecdote. 1 trade does not validate a system. 10 trades do not necessarily validate it either. In high-variance domains, you need to look at distribution, not episodes. How much do you make when you win? How much do you lose when you lose? What happens when the market moves fast? What happens when liquidity disappears? What happens when your execution fails? A real process does not only know how it wins, it also knows how it is wrong. And the better you know how you are wrong, the less likely randomness is to convince you that you are invincible. That humility pays, and it pays dearly. Third test: what event takes you out of the game, and what is your real exposure to it today? This is the most important test, because you can be right many times and still be eliminated by one badly designed exposure. Survival dominates average return. If a strategy has a non-zero probability of destroying you, time will ask the question enough times. That is why it is not enough to ask how much you can make. You have to ask what prevents you from coming back tomorrow. The case of Archegos Capital shows this in concentrated form. Bill Huang seemed to have winning conviction. There was wealth growth, concentration, aggressive exposure, and the appearance of a great stock picker. But the real structure was synthetic leverage through derivatives distributed among several banking counterparties that did not have a complete picture of the aggregate risk. The true exposure was not where it appeared to be. When the underlying assets began to fall in March 2021, the margin calls failed, and the banks absorbed multi-billion-dollar losses. The lesson is not that concentration is always bad. The lesson is that concentration plus leverage plus opacity creates a structure where an adverse move does not simply make you lose. It expels you, and when a loss expels you, you can no longer learn from it. You can only remember it. This also applies outside trading. Silicon Valley Bank seemed like a sophisticated institution within a premium niche. Startups, venture capital, technology clients, strong growth. But the model had accumulated exposures, low rates, concentrated deposits, a large base of uninsured funds, and duration-sensitive assets. When rates rose and depositors coordinated, the growth that seemed like superior execution showed its other side. It was not only good niche management, it was also exposure to a regime of rates and trust that reversed quickly. The same logic appears in a trading account, a fund, a startup, or a bank. While the regime helps, exposure looks like talent. When the regime changes, exposure goes back to being called by its real name. The practical action is to define limits before you need them. 5 non-negotiable limits. 1. Maximum loss per position. 2. Maximum leverage. 3. Maximum concentration per asset or thesis. 4. Minimum available liquidity. 5. Maximum correlation under stress. If you cross one, you exit or reduce. There is no narrative exception. There is no, "this time is different." That phrase exists to justify broken limits. The point of limits is not to avoid losses. Losing is part of the game. The point is to avoid a loss that takes away your right to keep trading. A robust operator is not the one who is never wrong. It is the one who designs his error so that it is small, readable, and recoverable. The audit question is direct. If your largest position drops 50% tomorrow, do you know exactly what you will do in the first 48 hours? What do you sell? What do you keep? What remains intact? What rule is activated? If the answer is not written, you do not have risk management. You have hope with technical vocabulary. And hope does not liquidate positions. The market does. There is another way to say it. The risk of ruin is not compensated by intelligence. A brilliant person can design a fragile structure. A sophisticated team can ignore a hidden correlation. A large bank can behave as if deposits are stable until they stop being stable. In every case, the mistake is similar. Looking at the visible return and not at the condition of survival. That is why limits have to exist before emotion. In cold blood, you can think. Under pressure, you negotiate with yourself. And when you start negotiating with your rules are no longer rules. They are suggestions. The operator who survives is not necessarily the one with the best prediction. It is the one who avoids being forced to make important decisions at the worst possible moment. Liquidity is freedom. Correct sizing is freedom. Low debt is freedom. Intelligent diversification is freedom. Not because they are conservative by definition, but because they give you room to act when others can only react. That is the difference between calculated risk and fragility dressed as conviction. If your strategy needs nothing strange to happen, it is not a strategy. It is a prayer, and the market is not obligated to answer it the way you want. Better to assume that early, much earlier. Now bring the 3 tests together. First, your gain has to survive scenarios that did not occur. Second, your decision has to be evaluated by process, not by result. Third, your exposure has to respect limits that are not broken by conviction. That is the complete architecture. You are not trying to be right all the time. You are trying to keep trading when you are wrong. That sentence is worth more than any return promise. Because in markets, investing, business, and career, the problem is not being wrong. The problem is being wrong in a way that prevents you from coming back. Skill exists, but skill without survival is a statistic nobody will read. Edge exists, but edge that only works in one regime is not a law. It is a condition, and conditions change. So before celebrating a gain, do a 5-question audit. Take out your phone, open your notes, answer based on your latest big win. Not to feel bad, to know what you are scaling. First question, in what specific regime did that gain happen? Name the conditions, rates, volatility, liquidity, correlations, market flow. If you cannot name them, you do not know what you were exposed to. Second question, if 2 of those conditions change at the same time, does the gain remain reasonable or does it become a large loss? Be honest. This single question filters out many strategies sold as edge when they were really dependence on the environment. Third question, did you write your thesis before entering, yes or no? If you did not write it, you do not know whether you won for your reason or for a different reason. And if it was for a different reason, you cannot intentionally replicate it. Fourth question, what is the maximum loss that would invalidate your entire process, not just this trade? If you do not have a number, your process does not have a process. Fifth question, how many other operators used your same strategy and are no longer here? If you do not know any, you are probably only looking at the side that survived. You are learning from visible winners and forgetting the silent evidence. This audit takes 10 minutes. But those 10 minutes may be worth more than your last year of returns because they show you what part of your confidence comes from process and what part comes from a story the result allowed you to tell. Do not judge a decision only by the money it produced. Judge it by the invisible risk you accepted to get it. If you cannot distinguish luck from skill, your gain is not an edge. It is a pending invoice with probability. And when probability collects, it does not negotiate. Now, I want you to do something more useful than commenting "great video." Tell me about a recent decision that went well, but do not only tell me how much you made. Tell me the thesis you had beforehand, the maximum loss you accepted, and the alternative scenario that would have taken you out. If you cannot tell me that, maybe you won by randomness, and that is fine, as long as you know it. The dangerous thing is not being lucky. The dangerous thing is confusing luck with skill and scaling as if the market had certified you. At Playbooks de Caja, we do not summarize books. We turn ideas into decision systems. And this system comes down to one rule. Before increasing size, before changing strategy, before building identity around a streak, ask yourself what part of this would still work if the regime changes tomorrow. If the answer is nothing, you do not have edge. You have favorable weather. And weather changes. See you in the next playbook. I will close with a practical distinction. This is not about becoming paranoid, it is about becoming calibrated. The paranoid person sees risk in everything and does not act. The naive person sees gains and believes he has already understood the game. The calibrated operator acts, but knows what he does not know. He takes risk, but sizes it. He accepts luck, but does not hand it the wheel. He reviews the result, but does not kneel before it. That is the maturity this book demands. Not less ambition. A better reading of randomness. Because the goal is not to win once and tell a beautiful story. The goal is to build a process that can receive gains without becoming arrogant, losses without going crazy, and rare events without disappearing. If you achieve that, you do not need to predict every move. You need to survive long enough for your real edge to have time to appear. That is the difference between playing the market and being played by it. And that difference matters, much more than it seems.